Tech stocks are selling off right now, but deciding where to allocate your capital means looking past the red ink and understanding exactly what is driving the slide. Right now, the Federal Reserve is holding the federal funds rate steady between 3.50 and 3.75%. Because inflation pressures are sticking around, the bond market is reacting. The 10-year Treasury yield is currently sitting elevated at roughly 4.55%. This chart tracks the year-to-date slide of both Meta and Amazon against that fixed 10-year Treasury yield. Those elevated borrowing costs act like gravity on capital-intensive technology companies. When money is this expensive, the market heavily punishes any company trying to fund massive new infrastructure projects. This environment forces investors into a rigid trade-off. You either accept the near-term volatility of a company spending heavily to build out its future, or you pay a premium valuation for a company whose infrastructure is already finished. Successful dip buying in 2026 hinges on your ability to manage the cost of capital. A familiar brand name provides no protection against the current interest rate environment. That brings us to Meta and Amazon, two dominant tech giants experiencing significant price slides at the exact same time. Meta's sudden drop is driven by market panic over an aggressive, highly expensive pivot in its business plan. Amazon, on the other hand, is experiencing a steady structural slide, even while maintaining its established market dominance. The decision looks like this. Do you try to catch a highly volatile stock backed by strong underlying fundamentals? Or do you pay top dollar for a stable business whose technical chart is actively breaking down? Selecting the right stock means diagnosing exactly why each is dropping and matching that reality to your personal risk profile. Let's start with Meta. The company has committed up to $145 billion to build out its AI infrastructure, including programs like a $115 million academy to train data center technicians. Looking at Meta's fundamental scorecard, the sheer scale and speed of that capital expenditure pivot has terrified the market, resulting in a 25% slide from its previous all-time highs. But look under the hood at the core advertising business. It is actually accelerating, posting 33% year-over-year quarterly revenue growth. Because the price has dropped while revenue is climbing, Meta's forward price-to-earnings ratio is currently sitting between 18 and 20. That is a massive discount compared to its 10-year historical average of 26. You are effectively looking at a deep value play. The market is compensating you for absorbing the short-term panic surrounding those AI expenditures. This technical candlestick chart for Meta shows the stock caught in a medium-term falling trend channel, currently trading right around $585. It is testing a critical razor-thin technical floor exactly at the $584 support level. Down below, the Relative Strength Index, or RSI, has plummeted to 27.8. This pushes the stock entirely into mathematically oversold territory. This sets up a clear binary outcome. If that $584 floor holds, the depressed RSI points to a high probability of a technical bounce. If it breaks, the negative momentum will likely accelerate. Entering Meta right now gives you a clearly defined technical entry signal, provided you can stomach the immediate cliff edge volatility. Shifting to Amazon, the structural story is entirely different. Amazon operates with a deeply established, globally dominant AWS data center footprint. This comparison matrix highlights the difference. Because Amazon's infrastructure is already built and operational, it isn't shocking its investors with the sudden capital expenditure pivots we see hitting Meta. The core business remains incredibly stable, with current quarter revenue expected to grow at a solid 17.4%. However, that stability comes at a steep price. Amazon commands a premium forward PE ratio, currently hovering between 33 and 34. This connects directly back to our macro data. Elevated multiples like Amazon's are exceptionally sensitive to that 4.55% Treasury yield we discussed earlier. Buying Amazon secures undeniable operational stability, but it directly exposes your portfolio to severe valuation compression risk if interest rates stay higher for longer. Pulling up Amazon's technical chart, we can see that exact vulnerability playing out. The stock recently formed a bearish double top pattern. It broke straight down through a major support level at $259, and the price is currently actively breaching its next floor around $247. Unlike Meta, Amazon's RSI is sitting near 42. That is neutral to bearish territory. It simply isn't mathematically oversold yet. The technical projection signals further downside toward the $243 to $245 range before a solid floor might actually form. The bottom of this dip has not arrived. Buying Amazon today means trying to catch a stock that still carries active downside momentum. This tree maps how you choose between the two, separating your portfolio goal from your risk tolerance. A value-driven opportunist looks for oversold conditions and discounted PE ratios. That path leads straight to Meta, securing a historically cheap valuation and a mathematical technical buy signal. Meta is the optimal play for aggressive investors, as long as you are willing to accept the inherent near-term volatility of these massive data center outlays. Returning to the flowchart, a long-term accumulator prioritizes market dominance over short-term bargain hunting. That route leads directly to Amazon, avoiding structural risks and securing top-line stability via AWS. But beware the timing risk. Technical traders should hold off until a true bottom forms. And if you are watching the broader economy, Amazon's premium multiple makes it uniquely vulnerable if the Fed decides to hold interest rates higher for longer. Do not buy the right stock for the wrong reasons. Look closely at the structural reality of each asset, and be sure to match it directly to your personal investment strategy.